Hi, guys, and welcome to the 23rd episode of the weekly trading wrap up, WTW, where we talk about the week in markets from a trader's perspective, what to focus on and what to ignore. So let's begin. As usual, we're starting here with a daily chart of the S&P 500. The red upwards pointing arrow denotes the week starting April 21st and ending on April 25th. This candle is Monday, Tuesday, Wednesday, Thursday, Friday. As you can see, it was a good week. We opened up down on very terrible news. We went to about 510 on the SPY, and then we're up 550. It's like a 40-point swing, like what 8% move the whole week. It's huge. And it's to be expected when we had such bearish conditions. Okay. But first of all, as always, we'll talk about the technical picture. Okay. Now, let's bring in some moving averages. The blue again is the 200-day. Ignore the rest. The red is the 50-day. Okay. We had that bearish cross, and as usual, when a bearish cross happens, it's a very lagging indicator. We have a market rip. So if you sold based on the bearish cross, it's pretty stupid. You're getting owned, squeezed. Okay, so first of all, we're still underneath the 200 and it's flattening out. Okay, we don't want to see it going down. That's bad. So as we are right now, overall, it's still a bearish setup. Okay, technically speaking. However, this big move this week, we could see something of a double bottom where we have here a higher low, and if it breaks this level here, which is the 550 level in the SPY, we can keep going higher. Okay, let's get rid of these moving averages for now. Just wanted to show you that technically speaking, we're still in bearish territory, so keep that in mind. And we have a huge bounce, which could be a short squeeze before the market turns lower, or it can go even higher. We don't know. But as of yet, we're bearish and we're squeezing. Okay. And okay, so let's get rid of these. Where is it here? Let's hide them. Okay, this is more clear. So I just want to point out the levels here that we have going back. We have these blue lines denote important levels. As you can see, going back, this is the 550 is a key technical level. We have here the previous high. This is a 565 level. This is a high right here at 575, which also coincides to this area here, which was a support before. The 575 level is support. So this is support and resistance here beforehand, before the market went down. So this 575 is a huge level. And of course, we have here the 585 level, one of those previous highs. We'll draw the rest. We can easily go to the all-time highs and draw a level there, of course. We'll do that later. But for now, we hit our first level of 550. We're looking at 565, 575, and then maybe 585. The 575 is probably the most important. Okay. So going back here, we were in extreme fear, and the first week ever we're back at fear, right in the smackdown of fear in terms of the sentiment indicator. This is big. I mean, we're still scared, but it's way better than being at the 3 level. Okay, we literally 10x'd our happiness from 3 to 35. I like to look on the bright side, people. Okay, but the AAII came out as well, and that's still extremely bearish and very low on the bullish sentiment. But this changes with price. Okay. Excuse me. All this to mention that we are still in rather fearful territory, and that is why we're letting these contrary indicators play out. When everybody's short, everybody's fearful, the market's going to rip. I don't care, even if you're bearish. You can't have maximum positioning with the put-call ratio at like 120, 1.2 plus. Everybody's buying puts. Everybody thinks a recession's happening, and we don't get what we want, especially when everybody wants it. Since when do the markets do what everybody wants it to do? Almost never. So the technical picture here is bearish. However, we have this bounce here that is starting to hit levels. Now, I don't know what's going to happen in the future. If we hit this 575 level, I mean, you should be taking profits at each of these levels if you're long, which I am, taking advantage of oversold conditions, as we mentioned last week. So the technical levels should look at the 565 next. 575 is huge. And then if we break up above this and hold above these levels in the coming weeks and months, and we approach the highs, that is bullish. It's not bearish. Okay, it's not like we're coming up to the highs and then we're going to go down again. It's more likely an extremely bullish event, especially if we close above the 200-day, which is right at 575. So this is a huge level, the 575 event. Sure, it's going to start going down, but not that much. So this is going to be a huge level to look for in the future. So that's it. As things look at right now, technically speaking, we had that bounce that we were expecting. It was a big one. Will it continue? I suspect we have a couple more, a little bit more fuel in the tank for it to rip. Okay. Again, 565 first, and look into 575. So still bearish, but it's playing out as we expected at oversold bounce. Okay. So that's it for the technical picture. Let's move into the macro picture for the week. Looking at the macros, we just had, there was a number of macro data coming out, but the ones that we look at was just on Thursday. We had the initial claims. That was it. There was nothing else that I look at that's big. And if you look at the initial claims, you see that there were 222,000. That's it. And remember, it's worth mentioning that this whole time that we were panicking in April, after the this great event here, what was it called? The Liberation Day here on Wednesday. The next day, boom, 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 massive volume and fear, massive fear happening. Okay, so we had the whole time initial claims. Nobody was, filing for unemployment. Okay, so we had this whole undertone of fundamentally strong macro data, holding macro data, while everybody was losing their head and panicking. Okay, this bears repeating. Okay, people think that the market runs on fear and greed. It does not. Well, they got part of it right. It runs on fear and greed. But the market really runs on two things. It runs on fundamentals, and two, emotions. Okay, the fear and greed come in during are part of the emotional stage. Okay, but I don't care what the emotions are. The market will always revert back down to fundamentals. Okay, like Warren Buffett said, in the short term, the market is a voting machine, and in the long term, it's a weighing machine. What he means by that is the voting machine is the short-term stuff, which is the fear and greed and the emotional stuff playing out that could dominate the fundamentals. But in the end, the fundamentals always win out. It could take years to play out, but the fundamentals are always correct. Okay? So here, fundamentally speaking, when we're talking about the macro, nothing really changed. It was just people's future perceptions of how bad things can get. Okay? So they just played the fear, but the fundamentals really haven't changed. So let's look at, we haven't looked at the fundamentals here, our fundamental backdrop here, the macro backdrop and our fundamentals in a long time. Okay, and we look at things like the number two. The first thing is GDP holding up. GDP is not the reasons to say bullish back in the day was GDP between 2 and 3%. Jobs holding up, inflation falling. Okay, so all of these things that we mentioned here, credit spreads, VIX, are these still in effect? LEIs, money supply, do we have these things still in our favor? Okay, has the macro turned bad or has it turned good? But let's do a quick overview of what we generally look at because we haven't looked at it in a long time. So one of the things that we look at is jobless claims, nothing. So no bad things here. Another thing that we like to look at is building permits. We see that all the time, okay? And building permits, we saw that last time they were at 1.47 million, which if you look at still holding up. It gets bad when building permits go down to like, a million, and if you look even further back, like I can't go to the max here because you have to pay for it, but if you look further back, it's like at 500,000, okay? So they're holding up. Building permits are holding up. So is anything bad? Nope. Okay, what else do we see? We saw M2 money supply. Is M2 money supply falling? Let's see the 1 year. Nope. Since January, money supply is going up. So that's supportive of markets. Okay. So money supply is not falling. Like if we had things like, look, here in 2022 when we had that little crash, money supply was falling. Okay, so that wasn't supportive of us, of a bullish narrative. It would be a bearish macro outlook. But no, it's going up. So we have that supporting us. What else do we look at? I like to look at the government deficit. We all like that because the bigger the deficit, the more stimulative it is for the economy. Up until it breaks, we know that it's stimulative until it's not. But so far it is in 2024. Look at all these budget deficits. We're running 6% deficit to GDP ratios. Okay, and if we look at it more carefully here, like in 2024, this is the budget and economic outlook from the CBO, the Congressional Budget Office. Okay, again, free data, you can check it out. If you look at here, 2025, that's projected that we have a total deficit of 6.2% of GDP. Okay, look, 5%, 6%, and we're not even at war. Okay, if you look carefully, like look, the average from 75 to 2024 is 3.8, but they include the 2020. If you take out 2020 to 2024, like from 1975 to what is it, 2019, it would be like 2.5%. Okay, so that's a normal 2 to 3% deficit to GDP. That's normal. You're not going to go nuts. You're not going to die with that. Now we're running double that. Okay, and we're not even at war. So that is stimulative until it's not. Now it's still stimulative. Okay, so we're running deficits that are stimulative. So the macro is good on that sense. So far, all the macro that we see are supportive of a okay economy and no recession. Nothing's going to tank soon. We saw money supply, the deficit. What else? We saw credit spreads. Okay, and this is starting to get scary. Like we saw, look at the 1 year picture of credit spreads. We saw during April, the credit spreads went up during that Liberation Day. Okay, this is the credit spread, by the way, on the Federal Reserve database. It's CCC bonds, rated bonds, which are like junk bonds, versus the option adjusted spread versus the pristine treasuries. Okay, so the spread between treasuries and junk bonds. Okay, so we saw here that during that fear-based move, credit spreads went up. But now look at them, boom, gapping down. Okay, as we speak. Now, like if we look at a bigger picture of it's going up, like is it going down here? Is it going to go down before going up again into a recession, which is the shaded area? I don't know. But so far, recently, it's going down. Okay, and because of that fact, we have the market coming back, going up here, going that. It's literally forming a higher low. Okay. Based on that. So we have all stuff that is stimulative and not devastating yet. Okay, this would be exploding. Let's see what happened here during the 2020. Can we go farther? Max. Look what happened in 2008. Really exploded much higher, the credit spreads. Okay, in 2020, we had it much higher. It was going up before. Like, could this be something like this? And it's going to happen soon? Maybe. But as of right now, no. We're still okay. And if we look at U.S. economic indicators, which is the next one of our macro, the Conference Board Leading Economic Index. These are a bunch of leading economic indicators all at once. You can like pause your screen and check it out here. Exactly, ISM, new orders, average consumer expectations for business conditions, etc. Building permits as we look at, okay. The ISM, we look at the ISM, which is a leading indicator, and we saw that it was okay, sort of holding recently. So these are the LEIs if you want to like pause your screen and check them out. But here is what you have to be looking at. Okay, these are the LEIs over time from the year 2000 to 2025 now. And when they get below this, it's a recession signal. This red line is a recession signal. Here in 2022, it went below. I mean, we didn't have a recession in 2022, but we did have the market go down 20%. Okay, same here before 2008 and 2000. Okay, this level is key. The -5 level in their process is key. We were below. Now we're above it. Could it Could it dip below that and we could have it soon? Yes. But so far the LEIs are below zero, which is bad, but they're climbing. Okay, they're climbing. They're getting better than they were in 2022. Okay, they're not crashing yet. So the leading economic indicators are all right. So far, all the macro that we looked at are not devastating. Okay, not a recessionary type of signal yet. And leading economic indicators are important. The credit spreads are recent, like you see them right away in the markets. You can see them right away. And of course, we saw here that the initial jobless claims are not lagging their concurrent indicators. So if we look at the leading economic indicators and the concurrent indicators, our macro says nothing to worry about yet. Okay. The last thing I like to look at is the yield spread. Okay, the difference between the 10-year Treasury and the 2-year Treasury, the difference in yields between the two. Okay, and the zero line here denotes that whenever it crosses below that and then goes back up, we have a recession soon. Look, it crossed below, going back up, recession soon. It crossed below the zero line, they went back up. This means below means an inverted yield curve. Okay, where the longer term interest rate is lower than the shorter term. It's a bad sign. Okay, so here we had a long period of an inversion, and then now we're back to a normal yield curve where the 10-year yield is higher than the 2-year yield. Okay, we have this, and we didn't even have a recession, so this is supportive of markets. Okay, they usually go down when something fast and bad happens, and the Fed has to react quickly. Okay, so this would tank when the market is already down 10, 15%, and the Fed drops it. But look, we had the market go down. Okay, we had the market go down 15%, 10, 15% quickly. Okay, but the Fed didn't lower interest rates like it would in the past. Okay, it kept them high because the economy is doing fairly well. So everything is fundamentally based. You can't just say, oh, in the past this happened, so therefore if it crosses, we're going to have a recession again. You don't know. Here we didn't have a recession. We had the longest drop in 2022. In 2022, the market was in a bear market, but the economy was not in a recession. Okay, so you have to take everything with a grain of salt. You have to look at the past as a guide, but you don't automatically assume that's going to be exactly like in the past. Okay, this is why the market is based on fundamentals and emotion. Don't let the emotion overtake the fundamentals. Okay, so this is a positive yield curve is supportive of the market. Okay, the Fed didn't cut rates when we were down 15%. They weren't freaking out. So what we have here is a situation where the macro is still fairly good, but the emotions overtook people here. Okay, and you can see that right here with high volume selling off. Okay, so this is why this is supportive. Okay, now could these indicators turn around? Yes. Does this give me hope that we can get higher here? Yes. I think we go higher here because we're still relatively bearish in our outlook, and nothing is really broken down yet. So the macro is still fairly okay, with a few exceptions here, like the spread is still pretty high, but it's coming down. Okay, so people are starting to not freak out anymore. And obviously, some indicators, concurrent indicators, never went down. So again, the macro is fairly good, nothing to worry about. It's just that emotions have been running us here and not fundamentals. Okay, that's what we can get from the macro segment of the WTW. Okay, so now let's talk about things that I've noticed this week. first thing, favorite subject, gold. Okay. So where's Monday? This is Monday. Okay. Gold opened up the week high because, as we saw on SPY, the market is driven by one thing right now, which is the tariff and trade war. They're not even looking at fundamentals. Okay, so on Monday that you saw the market gap down because Trump was like having a shouting match with Powell. He wanted to fire him. He wanted to like get rid of him and wanted to lower rates, and Powell didn't budge. Okay, and on Wednesday he said, I'm not going to fire Powell. Boom, the market rips on Wednesday. So again, it's just like a tariff headline, Trump-driven market. Okay, but let's go back to gold. Okay, so gold initially went up, and then when he wasn't going to fire Powell here on Wednesday, gold tanked, went down. Okay, so let's reiterate here. We had gold ripping to highs, and we had overbought conditions. MACD, everything is overbought. Okay, and now it came back down. Gold coming back down alleviated the overbought conditions. I wanted gold to come back down because you don't want it to be parabolic. You want it to go up in a stair-step fashion like it did here. You know, in 2024 when it broke out. When it broke out, boom, yeah, initial hit, consolidation, and then slow stair-step pattern upwards. Okay? So gold, the gold narrative right now is that because trade tensions are easing, supposedly, we don't need to buy gold anymore. Okay? So gold went down from the highs of what 3,500 down to 3,250. Okay, so a decent drop. Okay. Based on the fact that now things are going to unwind, tariffs are not that bad, so we don't need to buy gold. Okay, that's the view. This is the knee-jerk reaction. However, I'm not so sure that's the case because, as before, this is a very human thing to think. What I mean by that is that human beings are pattern recognition machines. Okay, so they see gold going up during the panic when markets are tanking. So therefore, if markets are doing well, gold has to go down, right? Why? Why therefore? Why do you go, therefore this must happen? Okay, I mean here, this whole time as gold broke out from this huge consolidation pattern, as it broke out, this whole time markets were going up in 2024, and gold was going with it. Okay, it had nothing to do with Trump here. There. This is all because of the fundamental play of central banks buying massive quantities of gold, especially China. Okay, now with the trade wars, do you think central banks, ex the Fed, okay, foreign central banks, especially the BRICS, are going to stop buying gold because the tariffs are going to be okay, or less tariffs than before? Still tariffs, just less devastating than before? I don't think so. I think this is why I think this is a perfect storm for gold. It's like, even if the markets go down, gold goes up. If the markets go up, gold is going to go up. That's what I think. There's going to be some corrections, okay? And this is a pretty mild correction, right? 32. It lost 200. It didn't even lose 10%, maybe 6% drop from highs to low, maybe 5-6%. I don't know if you look at the high, but from the close, not even close to 5%. So this, and look, as things were going good on Friday today, gold opened down, but it bought back everything as the markets were closing at highs. So there's a buyer in gold. There's a fundamental long-term buyer in gold because not only do you have the central banks buying before because of the BRICS, a move into gold based on what happened after the Russian invasion of Ukraine, but now you have people buying gold because of Trump's move on tariffs, because people are just not trusting the U.S. anymore. This is a new world order, NWO. Okay, and the new world order, you have to operate differently. Okay, you don't, we have yields staying high. Okay, we have the U.S. 10-year yield still relatively high, high levels, as markets are tanking. Okay, this was last week. So the yields went down again this week. Okay, so you have yields going down this week, which it should be supportive of gold. So you have like yields going up and gold going up, yields going down and gold still staying high. It's like, to me, this is a fundamental change on what's happening in the global economic system. And if you think gold is going down because the market is going to go up, I don't, I mean, you'd be wrong here. You'd be wrong, okay? Unless we see some more selling pressure going forward, I'll admit that maybe I'm going to be wrong on this. But I think that gold, look, the chart is telling you still extremely bullish. After a big move, it's consolidating at highs. It even alleviated the overbought conditions, more room to go even higher. Okay, so I think the story for gold is getting better as we speak. Okay, so that's what I wanted to mention regarding gold. I'm going to make a separate video on gold and what I think about gold and deflation specifically. I'm going to make it separately and then release it. But as of right now, my takeaway from gold is look at how it operates or how it's going to trade in the future. Okay, I'm convinced that as the market is going up, it'll start going up again. The narrative that it has to go down because the market is going up is incorrect. Okay, and you'll see it play out in the future. Okay, I'm fairly confident. Been trading markets for a long time. I'm fairly confident gold is going to still hold up, even as markets are going up. Okay, because this is a new world order. Next thing that I like to look at that we haven't looked at in a while is oil. Okay, I'm still bearish. Look, we broke this key level on U.S. oil. It's a WTI in the States. We broke this level. We're coming back. We hit it, not really, and then we're starting to go down here. Okay, for me, I took a short position around here on oil because I think we're going to continue to go down. I don't think the fundamentals of oil have been solved. If we do get into a recession going forward, maybe. I mean, who knows? But I know that the OPEC is, printing, drilling more oil as we speak. They're not sticking to their targets. They need it for various wars going on. And I think this fundamental and technical bearishness of oil will remain intact. I still think we go down into this 51st and then maybe all the way back down to this key level of 42 on WTI. Okay, so I am still bearish oil and nothing has changed for me. Okay, what will change is if we have a move back up above 75 and 80, comes back down, retests this and goes higher, I'm going to be bullish. Okay, something fundamentally has changed. I don't know what that could be, but if we do see that, okay, that's the only time I will change my mind. But as of right now, every other scenario, I'm still bearish oil. Okay, even as the markets will improve, the oil producing nations, OPEC, will start drilling more oil to satisfy that demand. Okay, so I think that oil is bearish going forward. What else should we look at? Oh yes, what we talked about last week and which came to fruition this week is Bitcoin. Boom. Boy, did we time it perfectly. Last week we were talking about this is this week. Okay. Monday, as the markets were tanking, Bitcoin ripped. That's how you knew you're on the right side by being long. Okay. Last week, we talked about buying Bitcoin here as it was consolidating. However, the options were still fairly expensive because of the VIX was above 30, so you had to buy them. For me, I bought the miners, and this trade is doing very well. Okay, I think we can continue to go higher as the market goes higher. Okay, so Bitcoin was holding as the market was tanking, and it's ripping as it's going up. So it was behaving very, very well to take a long here during this consolidation period. I'm going to get out when it hits the magical 100 again, at least half. I got out a very small amount here, like 10% of my longs on Bitcoin, but I'm really looking to get out at least half when it hits 100, like we did here. Okay, so the Bitcoin trade went well. You can see how the fundamentals of Bitcoin, it was holding up. And by the way, we talked about New World Order under gold. Well, this is the New World Order in Bitcoin. It was behaving like a safe haven as the markets were tanking. Okay, So it's like a hybrid security, just like gold. Gold was behaving as a not only as a safe haven, but as a risk on asset as well. Because as the market was going up, before gold was going up, and as the market went down during the Trump tariffs, gold went up. And the reason for that is we mentioned in the previous episode where gold loves uncertainty. Okay, but now we've got Bitcoin. Bitcoin seemed to love when the market went down, and now it loves it even more as it's going up. So I'm pro Bitcoin. I got rid of it a little bit here, not as much, but I'm going to get rid of a lot of it, at least half, when it hits the 100. Okay, who knows what can happen over the weekend? More positive news. We still have the fear and greed index here. I'm looking to get out of when it gets to neutral. Okay, do we get to extreme greed? That will be fantastic. Something has really changed. There'll be a complete change in narrative. But I'm looking to sell around these levels. I think this will coincide with the SPY at 575. This is a big level, okay, which I tend to like sell a lot at. But I'm basing, if you notice, that I am basing almost all of my exits and strategies on various vehicles, whether it be Bitcoin, whether it be, market stocks, on the SPY hitting levels. Okay, when the SPY hits levels, when the market does something, you want the market to be on your side if you're bullish, and you want the market to be on your side when you're bearish. Okay, nothing happens without the market first being on your side. Okay, we mentioned that before. So that's why I'm looking to unload a lot of the stuff that I have at SPY 575. So congrats if you took the Bitcoin long here with the rest of us. We're doing well. Everything is happening according to plan. We expected this bounce. I mean, will it hit 550 and go down to? We don't know. Like next week, it's all about next week. But so far, I am fairly happy with what is happening. It's looking like it's going our way. We're still not out of the bearish mode yet. We're still below the 200-day moving average. This could just be an oversold bounce. We don't know yet. So let's leave it at that. Let's thank the trading gods for this week, and looking forward to next week. Later, guys.